good afternoon, everyone, and thank you for joining us or staying in for round 2 of this. A wider panel now representing Leva Hotels, Louvre Hotels, Hilton, and Wyndham. And if I may invite my dear panelists to take a moment or two, introduce yourselves, your companies, and the brands you cover before we delve into the subject. Thank you.
Thanks, Anton. My name is Adil. I'm Development Director for Louvre Hotels Group. We're predominantly mid-scale oriented brand company, second largest in Europe, and we hope to expand here more in Saudi.
What's your current footprint in Saudi?
Sorry?
What's the current footprint in
Currently,
Saudi?
we're having 16 trading for pipeline hotels.
Thank you.
Hi, everyone. Amir Lababedi, Managing Director for Hilton. I cover Middle East and North Africa for development. We've got currently 19 hotels trading. 82 will be including the pipeline as well with our existing trading portfolio. So good to meet you. Thank you.
Hi all, welcome. Is the sound good? Yeah? No? Let's see. Yep, it's okay? Okay, very good. Panos, Market Managing Director, Türkiye, Middle East and Africa for Wyndham Hotels and Resorts. Globally 9,200 hotels. In the region, Türkiye, Middle East, Africa, 180, and in the Kingdom, 14 operational hotels. Thank you.
JS Anand from Leva. We have about 1,786 keys across Dubai, Saudi, Zimbabwe, Nigeria, and Ivory Coast. And we signed our first 5-star today in Riyadh on King Fahd Road, 140 keys. So that's a segment we wanted to get into, but it happened pretty quickly. So we're going to open in the next 60 days.
5-star hotel in 60 days. Subject for another forum, but we'll talk about it later. Congratulations, first of all.
Thank you.
Well done. So, gentlemen, we've had a couple of chats about the segment. Would you talk to us more about the demand that you're seeing from developers in Saudi in particular, more so in the region, and how you see that compared with demand for other categories of what you offer, particularly for the multi-brand chains?
Yeah, if you want, I'll start. So I think what we've seen in the last 5 years, there's been a significant shift in the demand profile of guests within the kingdom. We've seen a significant shift away from what was predominantly commercial related to the oil and gas sector, to government business. We've seen a big move now into the MICE segment, the leisure industry, sports, recreation, entertainment, all being driven by the Vision 2030. And I think this has really created a need for this type of asset class in this positioning, because they're starting to target a different profile of guests in terms of geographic source of business, in terms of the available budget, the travel budget that they have to spend as well. So we've seen demand for this product increasing significantly, particularly for international brands. Because if you look at Saudi, it's not undersupplied in the mid-scale. Actually, it probably aligns with the rest of the region, Middle East and Africa. It's about 56% of the supply in the kingdom is actually between the economy and the mid-scale or upper mid-scale segment, but only 10% of that is actually branded. So there's a massive opportunity there, I think, to tap into that unbranded supply in the mid-scale. Works well with our recently launched Spark brand, which we've brought into the kingdom recently, which will specifically target existing premium economy positioned assets, elevate the product and plug it into the system.
Nice, shameless plug of the day. But
Yeah.
So you're touching on something here. Is your growth happening through conversions of existing assets, or is it new builds? And I'm going to go to JS in a second to talk about speed to market.
Oh, sorry.
No, we're talking about the growth in this segment, whether it is through new builds or whether it is through conversions, and you've had a phenomenal experience converting buildings at a phenomenal pace. So I'd love an answer from
I think the market's not that well educated at this point in terms of wanting to go for mid-scale brands. I don't see that happening based on my experience that I've had in the last 2 years. there seems to be still a strong focus on luxury. These gentlemen have some great brands. We have a mid-scale brand called Econo, which is economy by Leva, and we have a 4-star too. For us, we have a smaller portfolio, and for us, it has to be a combination between conversion and new build. And I don't see that the market is really moving towards mid-scale as yet. It's taking a bit of time, but we are trying to focus a lot on tier 2 cities than primary markets like Jeddah and Riyadh. So we are working a lot towards in those directions at this point. But yeah, there is a market for it. I mean, if you look at the demand right now in Riyadh, you're talking rates are like 4,500 down to 2,000. My friend Panos is charging 10,000 at a Ramada.
10,000.
I'm just kidding. But yeah, there is a market for it, but it's going to take a while.
I think there is definitely a market for it, both in terms of conversions and new build. Conversions, everybody wants to get into this market right now, right? It's undersupplied. If you look back 10 years ago, people were saying that Riyadh was actually an oversupplied market. Today, it's the complete opposite. It's massively undersupplied. There's huge pent-up demand for accommodation in Riyadh, coming from a whole range of new source markets. The government itself has also, in Saudi, has also really stimulated the local domestic economy as well, because through welfare, through healthcare benefits, through housing, through education, really mobilizing the domestic market to actually travel more. And that domestic market, if you look at the middle class, it's actually increased by easily over 50% in the last 7 or 8 years. So you've got this emerging middle class with a budget-conscious traveller that since COVID, which really acted as a catalyst to activate these secondary destinations, needing that position, needing a price point that can work for them. So I agree. I think definitely in terms of secondary markets, we're present in Abha, we're present in Al-Assa, we're in Tabuk already. We've seen a significant demand for this type of product that the Saudi domestic traveller can visit. But in terms of conversions, getting into this market today with a mid-scale product, you'll drive supernormal profits for that asset class. Typically, a mid-scale hotel can achieve an operating or an investment-driven break-even point at a Hampton by Hilton, for example, would trade at around 300 riyals, and perform and achieve break-even points for an operating and investment level. But today you're seeing, like you said, a Hilton Garden Inn or a Hampton we've just opened in Neom. In under 14 months, we opened that hotel, doing rates of 1,300 riyals. So you've got this margin of from 300 up to 1,200 that you're able to achieve your returns in a much quicker time frame. So conversions, definitely. Our brands are all prototyped to drive efficiency for the owner. But as much as we can, we will adapt existing buildings to try and fit with the Hampton or Garden Inn prototype.
You have a courtyard down the street, and for the 3 days of the conference, the rates were, it's a 4-star, 2,300 per night.
Yeah.
That's impressive.
No, just
Garden
actually-
Inn's doing 2,000, Hilton Garden Inn. So yeah, that's a Waldorf Astoria sort of rates.
I mean, what's driving these super profits is A, your programming and your space programming in areas and built up areas, and B, probably your staffing guides and what facilities you offer and not. Panos, do you want to offer us a perspective on what do you insist on in mid-scale hotels versus what do you forego, and how much do you rely on the neighborhood, if there was a neighborhood? I know Neom might be a difficult case, but in Riyadh you'd have ample F&B, retail. In Dubai, Leva, you're plugged into a decent retail offering next to your hotel. So how much of your program can you shrink to reduce development costs?
So let's start by the fact that we have 25 brands, and in the region here we're trading 11 brands. And what is the common denominator between all the brands from 2-star to 5-star is basically the fire life safety. So this is one factor which is not negotiable. So we follow the American code and FPA codes, irrespective of whether it's a 2-star, let's say Super 8, or a 5-star Wyndham Grand. So this is with regards to the fire life safety. Then different brands have different standards, and some brands are what we call hard spec in our language, in our jargon language, which means that we want there is a certain prototype, as Amir mentioned, and then we want the hotels that are launched to basically follow the same design guidelines, if you want, in the terms of look and feel. And then we have other brands that are, let's say, more flexible and more accustomed to the designs. Now, when we look at a specific project, we always look at the micro market where the project is located. So we will look at the plot size, the setbacks, permissible built-up area. We would look at the demand and supply of the area, look at what kind of positioning would be relevant. Would it be 3-star, 4-star, 5, combination of a 3 with extended stay? Will the extended stay be at the standard level, at the premium level? And accordingly, so this is with regards to the room. And then with regards to the food and beverage or the other facilities, we would look at, for example, whether the place is a MICE destination, whether there is potential for MICE. Shall we complement the governmental facilities, if you want, in the destination with more meeting rooms so that we can complement this MICE business? In terms of food and beverage, for example, we would look, is the destination offering solutions for the immediate community? Because one thing that changed with COVID is basically the need to serve the communities that you're placed. And this is how hotels, the lifestyle brands, they grew more, the concepts of open spaces grew more, and you would see that people will come, work in the hotels, eat there, and we start catering more, all the hotel groups, into the local community. So then you will see what's available in the market, and you will make the decision whether for the number of rooms that you're developing, whether it would make sense to stick to the one restaurant or go for more facilities vis-a-vis what is available in the market gaps, etc. So it's always something that's been shaped in collaboration with the owners, if you want.
You have a lot of opportunity for conversion brands. And we, being a smaller operator, don't have that much flexibility to demand certain aspects of the brand specs. But there are some that we work with. And now what's happening is with the big boys, they also have conversion brands, which they take a ready hotel and you have a conversion brand. So, and post-COVID, what's happened is, just to give you an example, I just came back from Zimbabwe, and they're building a hotel which is going to cost them $1 million per key, 60 keys. So they don't understand the ROI behind that. And when I said that we're looking at about 250, 300 for a 3-star, depending on the location, that was surprising. So I think what we do is, there are certain aspects of the brand you don't want to compromise, but in most cases, you do tend to make soft cosmetic changes and move forward. It's a very competitive market out there, and I think the owners are getting more smarter now. I think you have to be flexible with them today. That's what I feel.
JC just touched on, for example, on the construction cost, like, for example, how mid-scale are much lower in cost rather than upper upscale luxuries. So, for instance, we have been looking on our prototype lifestyle mid-scale brand, Campanile, and thanks to the support that is just actually coming from the Ministry of Tourism, for instance, they just created a new tourism investment enable program for certain destinations across the kingdom, where you are incentivized with the tax exemption, etc., and basically your whole asset life investments that you are doing as an owner is reduced by 20%. So when we are looking, as we are mentioning now, conversion brands and the hard brands, the real hard brands, in terms of greenfield development and brownfield development, if you are looking just at a prototype lifestyle brand that we have, or a prototype hard brand, the normal one, the IRR there is varying between 15 to 22%. And that's what I think the owners nowadays across the kingdom and just in our region are starting to realize, that these are the much faster returns and maximizes the land use.
So that's driven by programming and optimizing the programming or forgoing certain elements. What about your staffing? How does that compare? Where do you see the opportunities in the market?
You need to provide the same service. As a hotel chain, especially all of us who have multiple brands, regardless of what scale your brand is represented, you need to ensure that your guest is getting exactly the same staff experience from the staff and the guest experience. And having said that, that's why in mid-scale hotels, in my personal opinion, it's much more important to ensure that your staff is fundamentally trained and their front of house, back of house are integrated technologically wise to ensure, because the FTE per key is much lower. So the importance of one staff member's interaction with a guest is much higher.
So the effectiveness factor has to be much higher because you don't have
Yes.
wiggle room. Is that?
What was your question?
Yeah, look, I think if you go back to the program, the whole model, our focus service, mid-scale brands, Hampton, Hilton Gardening, they've been tried and tested over 4,000 hotels globally, hundreds of thousands of rooms. We're continually refining the program based on market needs, on customer demands, on the needs of the developer. So these programs and the prototype itself is continually tested to be as efficient as it possibly can be. As soon as you start to move away from that prototype, you start to dilute the value of the brand to the developer, and that's not in our interest and it's not in their interest. We want to make sure that we deliver the brand promise. That's an efficient, consistent development, hotel building, and an efficient operation as well that operates at a level that we're fairly comfortable will be somewhere around 0.35, for example, for Hampton employees per guest room. If you start to move away from that and in this region we see it sometimes where developers are like, well, we'd like to add this, we'd like to add that. Well, that's not Hampton then, right? If you want a Hampton, that's what Hampton's been designed for. Let's not get carried away with like product creep or facility creep or amenity creep or anything, but let's just stick to what it's designed to do. Because as soon as you move away from that, the whole efficiency falls away and you don't get the value. But we do have a brand, the Spark brand that I mentioned that we've just brought into the region that can tap into the 90% of mid-scale hotels in Saudi that are not branded but would benefit from an engine like Hilton's and the standards and improve customer expectations, which is increasing all the time now, as you see with the number of visitors that are continuing to come.
So controversial question here. Spark hotels are less profitable than Heart-branded hotels? Just because you're not in control of the program.
Which hotels are?
Spark branded hotels? Is that?
I don't think necessarily. I think you've got to fit the brand, the product to the site, and then you fit the brand to that product, right? So each site has its own merits, and whatever is right for that is going to perform the best for the developer. That's the brand that we will propose. If it is that we want to put forward a Hampton, and Hampton works on a particular model from an existing building. So again, going back to that 90% of hotels in the mid-scale that are not branded, and we can make it. We've just done it recently in MENA, where we're looking at a conversion opportunity from an existing building for a Hampton as well. So to the extent possible, without diluting the brand value proposition, we'll do it. But if it doesn't work, then it's not going to benefit us or the developer. So whatever's right for the site.
Panos.
I will give a formula. So the facility schedule has a direct impact on the staffing levels and the staffing levels on the profitability. So for example, when you're moving up the star classification from a 3 to a 4 to a 5 star hotel, there is an expectation of a second restaurant or even a third restaurant. Now, the food and beverage department is characterized by low profitability ratios in the likes of 25%, 30%, 35% if you're lucky. The rooms department, on the other hand, is characterized by higher profitability ratios. It could be 70%, 75, 85, if it's in a simple extended stay product. So the facility schedule is impacting the staffing levels, and the staffing levels is impacting the profitability and the overall.
And it's also impacting your development cost.
Yes, so then you need to look like, because yes, you might have the best, let's say, GOP on a 3-star or an extended stay, but does the market need an extended stay? So once you do your analysis and you find the gap, you need to see whether this gap fits the market. Let's say the conclusion is to do a 3-star, but then how many rooms would be viable for this destination? And the typical 3-star will have one restaurant, but what if I'm in a market that basically lacks food and beverage solutions, you know? Why don't I put 3 of them in there, you know, and then, you know, I can capture the business. But this is how the formula typically would work.
I'd agree on, just if I can just add on to what Panos has just said. So where there is an opportunity to or a need to have, you know, food and beverage or even retail outlets to support that property, annexing that to the hotel is something that we do a lot of. So as long as we stick to the hotel, you know, the hotel operation sticks to the prototype, and then we can annex those additional facilities next door to it. And that's what you're seeing more and more of now in Saudi with a lot of mixed use. You see a lot more mixed-use developments. We've just announced one recently in Jeddah, the Souk 7 project, a fantastic project with loads of recreation. It's a retail, huge retail zone as well. A lot of like automotive industry, loads of different industries within one development. But we've developed a Hampton on the basis that it's got that F&B annexed next to it, and also the recreation facilities. So I think what we're seeing more of is developers really deconstructing the area program, pulling areas out, and, you know, providing them to third parties to operate.
How have you seen the rise of holiday home rentals affect this market segment of your hotels? It's pretty well regulated elsewhere. It's nascent here. There's a massive supply coming on. All the brands are looking to enter the kingdom without, you know, the Airbnb lookalikes, if you will, the regional ones. Do you view them as complementary? Do you view them as a threat? How do you factor them? How do you factor for that holiday home rental element when looking at an opportunity? And you've expressed pretty strong views in previous conversations, so.
I think it's a nuisance. Absolutely. I mean, you're giving out licenses for $700. So in Dubai, I think 700 or 800. I think it's just a colossal amount of holiday homes. And how do you manage them? I don't know. I mean, I don't see it as an opportunity at all.
But no, I'm not pitching it as an opportunity. I'm pitching it as an alternative or competitor potential to what you guys, to what we do.
Well, I don't know.
But
you know what? Very soon these guys will come up with another conversion brand on holiday homes also.
But historically, this has been a conversation when Airbnb was in the market, or Booking.com now doing holiday rentals. So it's not like a topic that arises now. It's a topic that's ongoing for years. But what has been proven, even after COVID, is that people have never give up on a branded service and a branded hotel and move towards the holiday homes or Airbnb.
See, I think I agree with Adil entirely. The market is not ready for a smart hotel, like, you know, just check in yourself. It's not graduated to that level at this stage. You can't compromise on staffing. You can't compromise on the offerings of the F&B outlets, like he mentioned. You have to keep that human capital, the human touch, and have those offerings. Holiday homes don't offer that. So I think even 3 stars are going to another level now in terms of really getting upscale and full service.
So, yeah, in Dubai, let's say, we have 154,000 rooms, and there is an additional 25,000 homestays, so units. So it's a very good percentage. It's like 16%, let's say, of the overall. Did I calculate well? 54, 25? Yeah, 16%. No, I had the number memorized. You know, I didn't calculate it now. It's too late to be so good in arithmetics. So now, when you have so many homestays in a market that's robust and there is a lot of demand, because Dubai is trading at the 80s, at the 90s, it's not an issue. But let's say if there is a decline in the performance and it goes down to 65, 70, 75%, those developers who have developed, let's say, a 5-star deluxe hotel at the cost of 500, 700, $1 million US per room, excluding land, they will have an objection having 25,000 units out there. Some of them are substandard, not reviewed. And yes, DTCM in Dubai does a great job, reviews each and every one of them, and you get your permit, and then you can trade. And you pay a little tax, and that's it. But that's not the regulation everywhere, you know. Like I'm a Greek in Greece. You get somebody from the platform to review it, but there's nobody from the government checking whether your unit is in a fire life safety compliant building or you have basic facilities, et cetera, et cetera. That's been a blessing, especially the last, let's say, 10 years, Airbnb and the likes, of redeveloping the city centers that were abandoned with old buildings that were dilapidated, et cetera, et cetera. So there were a lot of incentives to homeowners to basically take funds, renovate them. The city centers became livable again, became safe. They were reactivated, but it reached the point of saturation where the local populations cannot find, let's say, in student towns, students cannot stay in the towns anymore. The locals in a downtown, previously quiet neighborhood, they see people coming in and out, partying, they don't like it, they are objecting. And we see the over-tourism manifestations in different cities that require different measures to try to control the visitation of those destinations. It's becoming complex, it's shifting. Different destinations in different, let's say, frequency. In the region here, we have not had the problem yet, but what's happening in Europe and other destinations, it's basically showing us where it could go in the future.
And if you were to share a few words of wisdom based on what you've seen in evolved markets, what would those be for Saudi Arabia in terms of how to address the holiday home rental and to ensure that it supplements but does not compete with what you are doing?
Yeah. So to me, it's very simple. If a destination wants to be competitive, then the destination needs to regulate, irrespective if it's UAE, or, Saudi, Egypt, or needs to regulate the supply, the offering. Regulating means needs to establish, let's say, start licensing requirements. What defines an establishment as a hotel? What defines an establishment as an Airbnb or as a homestay? So the first thing is licensing requirements. The second thing is star classification requirements. What kind of facilities should be in the building to basically be a one-star hotel, a two-star, a three-star, a four? Same with the homestays. There should be a review. There should be, some kind of minimum requirements. So I think if a unit needs to trade and that trade competes with, let's say, hotels and multi-hotel developers and all these things, there should be some kind of, minimum, let's say, facilities or minimum safety measures, that are available for the international tourist to basically experience. And this is for the benefit of the destination at the end of the day. Yeah.
So we've got 7 minutes to go, and I'm going to give you the opportunity for last words before we open the mic for questions. We spoke about Vision 2030 and its drive to developing cities. Have you guys seen the full drive through for all the cities, or are there still untapped areas that you consider going to, that you have not been to yet?
I would like to go first, but I would like to cover a subject that maybe we didn't cover enough, considering the title of the panel. So I've been looking at some statistics. I've been researching before our panel just to get some statistics to share with everyone. And I found some reports from Knight Frank, and I can quote them because they've done a lot of things in the market. And basically looking at the current supply, so there is 149,000 rooms. And there is a good 66% or whatever the numbers is, which is upscale and above. So upscale, upper upscale, and luxury. And then there is 320,000 rooms in the pipeline, of which 220,000 will be in giga projects. And of the 320,000 rooms pipeline, 102 are already under construction. And if we look at the statistics and the split, the breakdown of these rooms, it's a good 82%, which is upscale, upper upscale, and luxury. And basically this is problematic. Why is it problematic? Because the destination will become exclusive. And this is a problem because not everybody has the $200, $300 to come and stay. And if we want to attract people and allow them to come again and again and go to the different destinations and go to what we operators, we call sometimes secondary and tertiary cities, which is basically smaller cities and much smaller cities, we need to create a product which is basically inclusive and not exclusive. So this is where economy and mid-scale, so let's say 3-star and 4-star hotels, are basically enablers. And they're there to, what we call in that Wyndham, democratize travel. So make travel possible for all, so that people can come and people from different budgets can actually be accommodated. And this is what we need to correct, if you want, into the future, to make sure that we have a sustainable visitation, you know, that keeps coming back.
There's a strong imbalance there. I mean, 82% of upper scale luxury, I mean, that's pretty high if you look at it in terms of, I went to a meeting this afternoon and it was very clear. They said we don't want any other projects, any mid-scales. It's going to be all 5 stars. So I don't know what the vision is, of course, there, but you need to cater to every segment of the market.
Yeah.
Everybody's not going to pay $1,000, $2,000 a night.
Not only that, but in some of those hyper-exclusive destinations, one has to recognize that your hyper-exclusive guest travels with a team, travels with an entourage, and not all of them are going to be staying at brand so-and-so for $1,000 a night.
Yeah, but Anton, you have major markets around the globe which have luxury hotels, but you do have the mid-scale around the corner that is affordable. So are you suggesting that a particular segment of the market can't go to this exclusive destination?
I'm agreeing with you. All I'm saying
Yeah,
is, in addition to what you just said, not only do you have to diversify from the exclusivity, but also to make the exclusivity succeed and to attract enough people to stay at these $2,000 a night hotel rooms, you need to allow them to bring on the support
You
system
bet.
they travel with
Anton,
in other destinations, evolved destinations, whether you want to mention
Yeah, but
South
if you look
France or
at- if you look
whatnot.
at- if you look
You've
at-
you've got the suburbs of every city where the support system stays. Or
Trojena, for example, right? I mean, you know, they're developing the Asian Winter Games there. You know, the plan is to have that open in the next couple of years, but there's actually no hotels that any of the visiting consultants and contractors and suppliers and everybody involved in actually making that happen can stay. So that's where we saw immediately the opportunity in Neon to develop the Hampton by Hilton, which opened in under 14 months from actually starting construction. That's, I think, where there is an immediate opportunity, and I think once those economies, around the giga projects and also the secondary and tertiary cities that we see developing, in the midterm, you can generate supernormal profits. And once the market starts to mature and more supply comes in, the performance then starts to come down to a more normal level that these hotels are anyway expected to
by
trade
that time, they would have paid for themselves
which
multiple times.
by that time you would have. So in terms of like the development risk, in terms of the operational risk, I think this is the opportunity now is
I think
mid-scale. certainly.
Panos has some great knowledge of this market. I think he should be a strategic advisor in this tourism body.
But
My
coming back to
president
your
is
first
hearing,
question
no,
about
he
the
didn't hear.
traveler
Maybe they close their
preferences
ears.
and going back to geography of Saudi Arabia. Size-wise, Saudi Arabia, and that's why I think the demand is robust. Size-wise, Saudi Arabia is the same size of the Western Europe. Population-wise, it's a huge population, 36 to 40 million people last time I've checked. And most of them are millennials and Generation Z who are prone to travel towards the more budget-oriented options, which are the mid-scale. And this is going to be the trend going forward and forever, most probably.
Understood. Any questions from the audience in closing? I'm not sure if I'm seeing cameras or hands up there, but I won't keep you any longer. Adil, Amir, Panos, and JS, thank you so much.
Thank you, Anton.
Pleasure. Thank you.
Thank you.
Thank you.